Hello, and welcome to Behind the Data with me, Glen Pereira. Today we'll be taking a closer look at the key factors that have been shaping the energy market since our last update at the end of October. Our top three drivers for prices in November remain the same as last month: temperatures, geopolitics, and liquefied natural gas, also known as LNG. Let's start with temperatures. Temperatures play a critical role during winter, acting as one of the dominant drivers of both demand and price formation. This month has been relatively mild, with temperatures consistently above levels we've seen in the past 2 years. As a result, underlying gas and power demand during the first half of the month has been noticeably subdued. In fact, it's been the lowest period for the last 4 years. This soft demand profile has helped keep spot prices contained and reduce the need for higher cost marginal generation. At the same time, wind generation was consistently lingering around seasonal norm. This provided an additional buffer against the occasional colder spells, helping stabilize day-ahead prices and reduce short-term volatility. The combination of softer heating demand and healthy renewables output created a fairly comfortable supply and demand balance for much of the month. However, weather forecast for December added a layer of uncertainty. Models fluctuated significantly, swinging between near-seasonal expectation and more bullish below-seasonal outlooks. This shift influenced forward curve, introducing a modest risk premium as traders positioned for a possibility of colder start to the winter. Despite this, the overall impact on prices remained contained, largely due to mitigating effects due to geopolitical development and strong energy supply supporting the market. Looking at second driver, geopolitics. Amid the ongoing volatility in temperature forecasts, the real catalyst for market downward move was a series of media reports claiming that Washington and Moscow had held secret talks and drafted a 28-point peace deal without Kyiv's involvement. The leaked proposals pointed to a major concession to Russia, including recognition of control over certain occupied territories, a cap on the size of Ukraine's armed forces, and a constitutional pledge that Ukraine would not join NATO. Markets reacted swiftly, interpreting these elements as a potential de-escalation in geopolitical risk, which triggered a sharp sentiment shift and pressured prices lower. As you can see on the graph, surprisingly, front-month gas fell more than 10% during the talk period, despite the limited direct impact on such peace framework that could have on delivery period. Front season and number of further dated contracts also slid to new yearly lows. It's a clear reminder of how sentiment during the market remains, even against the backdrop of Europe's firm stance on reducing dependence on Russian gas. And our final driver is LNG. European storage has been depleting rapidly, and based on the current forecast, we are likely to exit this winter with lower storage than last winter. Despite this, prices have remained relatively contained. A key factor has been the surge in LNG exports from the US, as you can see in the chart, particularly from Plaquemines, which has substantially increased output. US LNG exports are currently at all-time high and running at full capacity. The loss of Russian gas earlier this year did add risk premium to contracts, reflecting the concern over supply tightness. Looking ahead, additional volumes are expected from both US and Qatar, while competition from Asia is likely to remain subdued. The growing supply surplus is helping offset the support from low storage levels, allowing markets to remain relatively calm despite the tight fundamentals. And finally, here are the things to look out as we head into December. It'll be crucial to monitor developments around potential Russia-Ukraine peace deal. Over the past month, much of the downward pressure on prices have been linked to the reports of a progress in negotiation, with the markets reacting strongly to any news suggesting concession or movement in talks. Positive developments such as agreements that could reduce risk of escalation or signal a de-escalation of hostilities tend to weigh on prices as traders factor in lower geopolitical risk. Conversely, any setbacks or breakdowns in the talks could trigger the opposite effect, pushing price higher as the risk premium returns to the market. Given the sensitivity of both gas and power markets to geopolitical signals, even incremental updates on the peace process are likely to drive short-term price swings and influence forward curves for coming winter months. Thank you for listening. I hope you found this update useful.